In this lecture, I will try to solve two exams. First exam is what I call a mock-up exam, which was the exam from the June of 2012, December 2012, and the next one is going to be from December from June 2013 actually. So December 2012 and June 2013, which was the retake exam, and they will be very similar, as you can see. And your exam will be somewhat similar. It will be very similar in difficulty, but of course I will have to change problems a little bit. So let's start with problem number 1. Problem number 1 states the following. If the present value of $1 received in n years from today at an interest rate of R is 0.385, then what is the future value of $1 invested today at an interest rate R for n years? Now let's try to think about this problem. How I would think about every problem. First, try to see what is the question here. And the question here is, what is the future value of $1 invested today at an interest rate R for n years? Now, you know the answer to this question. Future value of $1 invested at an interest rate R for n years is given by this formula. $1 times 1 plus R to the power of n. Now, the problem is that we don't know R and we don't know n in order to be able to answer this question. But we have something else given in this problem. And what is given is the following. If the present value of $1 received in n years from today at an interest rate R is 0.385. Okay, so how do we calculate the present value of $1, which is in n years from now at an interest rate R? Well, we discount it. Present value of $1 discounted with 1 plus R to the power of n, and this states that this is equal to 0.385. Okay, from this problem, what you can see is that you can actually express 1 plus R to the power of n. So 1 plus R to the power of n is equal to 1 over 385. Now you can plug it into your future value formula. And you can solve this problem. And you obtain $2.59 basically. And this is how the question looked at the exam. As you can see, you have a question. First, the question starts with a number of points. It gives you approximate number of minutes that you should be able to solve this problem in, because exam carries 60 points and lasts for 60 minutes. And you have a space for calculations. And you have to mark a correct answer out of multiple choice possibilities. One of them is not enough information, for example, if you cannot calculate it. However, pay attention. Even if some things are really trivial to calculate, and you will see some of them were really trivial. You didn't really need to do lots of calculation to come to answers to some problems. Here, yes, here you need to do something. But the point that I'm trying to make is that try your best to provide some calculations in the space for provided calculations. Why? Because if you make some mistake when you're typing in the numbers in your calculator, you might end up with the wrong answer. And then if you don't put anything in this space where you actually have to write down things, I will have no idea what you have done, and I will have to give you 0 points if your answer is wrong. But if you did calculations correctly, and you missed some number, I don't know, you did something little wrong, I will basically be able to give you some points on that. So if you have time, try to write down something in this space, because this will give me an understanding what you did and where did you get it wrong. Okay, we go to question number 2. Question number 2 is actually not my question, but is a question that was asked by Goldman Sachs on one interview to one app students. I don't know whether this is a true or this is just an urban myth, urban legend, but apparently there was one awesome app student that managed to get an interview for the internship at Goldman Sachs, and they asked him the following question. General Electric has about 10.3 billion shares outstanding, so shares or stocks. And price of each of these stocks is $37.10. The price earnings ratio is about 18.3. What is the value of General Electric? Now, what is the point of this question? Well, this is kind of a trick question. And I'm asking it, this is basically the only trick question that I have in my exam, that I had in this exam. Usually they are quite straightforward if you know what you're doing. But this one is kind of tricky. Why? Because it tries to mislead you. And it tries to mislead you by providing you with redundant information, with information which is not actually needed to solve it properly. And the information that is not needed at all is this PE ratio. You don't need it at all. The value of a company is number of shares outstanding times the price of the share. And this is the value of a company, and that's it. And apparently, one app student, which was actually one great student, did not know how to solve this question. Well, I don't want this to happen again. I would really, really like that you are able to answer these kind of questions correctly in your interviews, and this is why I have asked this question. Because you learn, once you have it on the exam, you learn how to solve it correctly. Or once you have it in a class which prepares you for the exam, you learn it. Okay, a forward rate which prevails from period 3 to period 4 can be either observed in the marketplace or extracted from spot interest rates with 3 years and 4 years to maturity, or it could be maybe extracted from 1 and 2 year spot interest rates. So let's first think, how do we calculate this forward rate that goes from year 3 to year 4? I told you, try to do the thought experiment. So this goes from year 3 till year 4. Try to do a thought experiment. How can you invest your money in a bank for 4 years? Well, you can go into a bank and you can ask them, okay, I would like to invest my money into a bank, what for 4 years? And then they will give you one contract. And every bank will give you some rate, and let's call this a rate, a 4-year spot rate. This is a rate that you will get today for an investment of 4 years. But alternatively, you can go to a bank and sign 2 contracts instead of this one that will do exactly the same thing. And what is this? How are these 2 contracts going to look like? Well, you will first sign a contract that you will invest your money for 3 years. Then the bank will give you a 3-year rate. And you sign a contract today, an additional contract today, that you will invest your money for 1 more year. And this will be the forward rate from year 3 till year 4. So what we have here is 1 plus R4 to the power of 4 is equal to 1 plus R3 to the power of 3 times 1 plus forward rate from year 3 to year 4. This is what the thought experiment that will give us the answer to this question. And what we can observe from here is that in order to calculate the forward rate from year 3 till year 4, we actually need the spot rate for 3-year maturity and spot rate for 4-year maturity, which means that the correct answer is B. Now, think about it in real life. This is a very useful thing. Because if you go to your bank, you can go to the website of your bank. You want to buy a car. If you want to buy a car, if you wish to repay your car in 5 years, your bank will give you a 5-year spot rate. If you wish to buy a car for 10 years, to take a 10-year loan, they will give you a different rate per year. Now, using these different rates, these spot rates, rate 4, rate 3, then you can actually calculate the forward rate. So forward rates are what are called implied by the term structure of interest rates. The duration of any bond is the same as its maturity. True or false? Anybody?
False, it's not all bonds.
Exactly, it's false. It's not for all bonds. So this is true only for zero coupon bonds. The duration of zero coupon bonds is equal to its maturity. But for all other bonds, the duration is actually smaller than its maturity. Now we come to the problem where you need to calculate bond prices. And the problem goes like this. A US government bond with a face value of $1,000 has a coupon rate of 5% with semi-annual coupons and matures in 3 years. You have obtained the following rates from the website of the US Treasury. The rates are expressed as nominal annual rates with semi-annual compounding as usual. And if some rates are missing, for example, if you don't have 1.5-year rate here, you take the average between 2 and 1, okay? So the first part of the question is very simple. Draw the diagram representation of the cash flow stream offered by this bond. And this is the description of the bond. It's a face bond with a face value of $1,000. It has a coupon rate of 5%, and coupons are paid semi-annually, and it matures in 3 years. So we know that coupons will be paid every 6 months. We know that the coupon size will be, so 5% of the face value is $50. This is $50, but they are paid semi-annually. So this is $25 will be the size of a coupon. So this is how the bond will look like. Every 6 months, we will receive a coupon of the size of $25. And finally, when the bond matures in 3 years from now, we will receive the face value of $1,000 plus the last coupon. That's it. That's 2 points. When you are drawing these kind of things in the exam, I mean, be tidy, but do not be too precise. You see, when I'm drawing this, I'm not insisting that this 1025 is actually proportionally larger than 25. I don't care about these kind of things. What I care is that, you know, you actually understand what's going on, that coupons are 25 and the last payment is 1025. I don't care whether this line is exactly like, I don't know, 5 or 50 times higher or something like that. Okay, what is the present value of the first 5 coupons? So first 5 coupons are $25 every 6 months, and we need to calculate their present value. The present value of the first coupon will be $25 discounted. Since it matures in 6 months, we have to use the 6-month rate. What is the 6-month rate? In this table, 6-month rate is 0.05%. Pay attention on the units. The units are percents. This is number 1. So when you plug it into the formula, you should convert it into decimal by basically dividing it by 100. And moreover, these units are nominal annual with semi-annual compounded. It is clearly stated in the exercise. So what does it mean? Well, it means that you actually receive half of this amount every 6 months. So these are nominal annual rates. So these are annual rates, but you receive half of it every 6 months. So 6-month rate is 0.05 per year. Half of it you receive per 6 months. So 6-month coupon is discounted with 1 plus half of this rate. Now, 1-year coupon will be discounted with the 1-year rate. What is the 1-year rate? 0.11%. But this is nominal annual with semi-annual compounding. So you receive half of it every 6 months. So there are 2 6-month periods. This is why we have to the square. You have to compound this rate to calculate how much is it effectively per year. Now, the third coupon matures in 1.5 years. But we do not have the 1.5 year rate. So we have to take something in between 1 and 2 years. So what is in between 0.11 and 0.22? Well, it's exactly 0.6165%. But again, this is nominal annual with semi-annual compounding, so half of it you get every 6 months, and there are 3 6-month periods in 1.5 years, so this is why it's to the power of 3. Then you would do the same thing for the 3.5, for all basically, for all these, like 6 months, 1 year, 1.5, 2, 2.5, and you would get the present value. And this carries 4 points. Now we go forward. What is the present value of the payment that this bond gives at the date of its maturity? At the date of its maturity, we know that this bond will give the face value plus the last coupon. What is the present value of this payment? Well, we need to discount it. So this is 1,025 divided by 1 plus 3-year rate is 0.37. 0.37, this is nominal annual with semi-annual compounding, so we divide it by 2. This is how much you get every 6 months. And there are basically 6 6-month periods in 3 years, so we get the present value. Now, estimate the market price of this bond. Well, the market price of this bond will be the present value, will be equal to the sum of the present value of the coupons and of the last payment, and we get the market price of this bond. And that's it. And this exercise carries 9 out of 60 points on your exam. So this is a pretty large exercise. it's pretty straightforward. So if you know how to calculate prices of bonds, you would already have like almost 1/6, which is like quite a lot, 16% of your exam just in this exercise. And yeah, that's it. Then the next big exercise was related to calculations of the present value of a large and complex cash flow stream. Now let's see how do we calculate the present value of a large and complex cash flow stream. Now this is very important. This is the most important exercise. It carries almost 20% of your exam. Why do I insist so much on calculations of present values? I told you. Getting out of the business school and not being able to calculate present value of any cash flow stream is like getting out of elementary school and not being able to write. Calculations of present values in business school are what writing is in elementary school. So this is a thing that everybody should know. So let's see how this problem goes. You have a description of a cash flow stream. You have a discount rate, which is 6%. And I will now ask you first to please draw me this cash flow stream. Show me how it looks like. Then you have to translate this text into a diagram. And first you have an investment of $1,000. Then you have 3 payments of $151.63. Then this cash flow starts to decrease. It gets smaller and smaller until it reaches 25.29 in year 20. And then it continues paying 25.29 forever until eternity. Okay? That is approximately how it would look like. You see it carries very little points. It carries only 2 points, this drawing, because more or less everybody can draw this, and you don't really need to think too much. And as I said, you don't have to be too precise. I don't expect that, you know, that difference between the length of the lines that describe year 4 and year 5 payment is actually 10%. No. I mean, just make it obvious that it's more, whether it's 10% or some other percent, I don't care. But write it down. This is 10% decrease. Okay. Then I ask you, what is the present value of the cash flow streams received in year 1, year 2, and year 3? So these are these cash flow streams, and this is how they look on our timeline. So what is the present value of these cash flow streams? Well, you just need to calculate present value of first cash flow stream plus present value of the second cash flow stream plus the present value of the third cash flow stream. And that's it. This is the present value of the first 3 cash flow streams. Okay, now we come to a little bit trickier part. What is the present value of the 17 cash flows received in years from year 4 till year 20, both year and 4 and year 20 included? So this is the description. Year 4 is 136.47, and it decreases at a rate of 10% until it reaches 25.29 in year 20. So this is our cash flow stream. So what is the type of this cash flow stream? We have derived the formulas for different types. And this is what is actually a constant growth annuity. Why is it annuity? Annuity is, it's not a perpetuity, it doesn't go forever. So it goes up to some period of time. Why constant growth? Well, the growth rate is here negative. And we never said that the G should be positive. G can be negative and our formulas will also work. But you know, this is how we describe the constant growth annuity for cash flow stream. And this was the formula for the constant growth annuity cash flow stream. Now what you can observe here is that first, this formula assumes that the first payment is in year 1. In our cash flow stream, the first payment is in year 4, as you can see on the top diagram. So we have to adjust this formula to be able to work. This formula will not work. You just plug in numbers and it gives you the correct solution. So how does it work? Well, put yourself in the perspective of year 3. From the perspective of year 3, this cash flow stream looks just like a normal cash flow, just like a normal constant growth annuity. It starts in 1 year from now and it goes up to some period. But pay attention on the timing. So this formula tells you C1, okay, this becomes your C1. 136.47 becomes your C1. This is the payment in a year from now, when you're standing in year 3. But what is T? What does the T become? Well, T is not 20 anymore. T is not 20 anymore, because from the perspective of year 3, this 20 looks like 17. And pay attention on one more thing. This formula has C1 over R minus G. What is G? G is minus 10%, is minus 0.1. So R minus G, when G is negative, actually becomes R plus 0.1, okay? And this formula will work, but this formula will now give you the present value of this cash flow stream in year 3. So you need to additionally discount it for 3 more years to calculate how much is it worth today. And you end up with $671.78. Okay?
If I understood well, the new year 0 is the old year 3. Right?
Exactly. So it is like you are calculating the present value from the perspective of year 3. So you would calculate perspective from year 3, then you would get this, but you still have to additionally discount it to calculate how much is it worth today. Okay? Okay. Let's move on. What is the present value of cash flow stream received from year 21 till eternity, including the cash flow stream received in year 21? So how does this look like? The first cash flow stream is 25.29, and it goes on like that until eternity, forever. So this is our cash flow stream. How is this cash flow stream called? It's called perpetuity. So perpetuity is this, and this is the formula for calculating the present value of the perpetuity. But then again, pay attention on timing. In our perpetuity formula, the present value is calculated under the assumption that the first payment is in year 1. And in our cash flow stream, the first payment is in year 21. So we have to adjust this formula a little bit. So from the perspective of year 20, this looks like a normal perpetuity. So this formula C over R will give us the present value in year 20. So this will be the present value in year 20, C over R. How much is it worth today? Well, today we have to additionally discount it for 20 more years. And we end up with the present value. That's it. What is the total net present value of this whole project, including the initial investment? Well, that will be initial investment plus all these present values that we have calculated, and you end up with some number. Okay? This is almost 20% of your exam. As I told you, I'm insisting on this so much because this is what is the literacy of business schools. Every student in a business school must be able to calculate the present value of any cash flow stream. That is simply like you don't know how to write in elementary school. I'm not joking here. And with probability 100%, you will get some complicated cash flow stream to calculate its net present value, and it will carry approximately the same percentage of the exam. Okay? Now, the next 2 questions will be related to understanding the compounding frequencies, that you understand how to convert the units. In other words, when somebody tells you that he weighs 100 kilos, that you are able to calculate how many pounds he has. This is basically the equivalent. And the question will go, an interest rate is 15% per year and is expressed as nominal annual with annual compounding. Now I'm asking you, how much you would have to actually, what interest rate you should have to charge, which is continuously compounding, to earn you the same amount of money after 1 year. So how do you calculate that? Well, You just need to solve this equation. Why? The right-hand side of the equation tells you how much more you will get after 1 year when it's nominal annual with annual compounding. The left-hand side equation tells you this is how much more you will get after 1 year if it's nominal annual with continuous compounding. How do you solve this equation? Well, you take the log of the left-hand side and the right-hand side, and that's it. So what does it mean? It means if you go to a bank, and bank offers you a nominal annual rate of 15% with annual compounding, you will earn exactly the same amount of money as if the bank offered you, after 1 year, as if the bank offered you 13.98% with continuous compounding. This is the point. So I want you to understand how to convert units, how to convert kilos into pounds, and vice versa. This is important. This is the essence of what we do. Interest rate calculus is the basis for the net present value and, in general, time value of money concepts. Okay, similar question. Interest rate is 8% per year when expressed with continuous compounding. What is the equivalent nominal annual rate with semi-annual compounding? So 8% with continuous compounding, this is e to the power of RT for 1 year. How much do you earn with nominal annual with semi-annual compounding? Well, you earn 1 plus R divided by 2 to the power of 2. You solve this equation and you get 8.16%. In other words, in back gives you a quote as nominal annual with semi-annual compounding of 8.16%. Effectively, per 1 year period, this is the same as you receive 8% with continuous compounding. Okay, we move to a bit different part of the exam. We are moving to the part of the exam that deals with stocks and with risks and return and stuff like this. So you're given a table that looks similar to this one. And in this table you have values of these firms. These numbers are obviously invented to make your calculations easier. You have expected returns, you have expected standard deviations, and you have the correlation coefficients between each of the pairs of these firms. And then first thing that I would ask you is create a value-weighted portfolio. Why am I asking this? I want you to know how to calculate weights in a value-weighted portfolio, because we have seen in our class that actually the value-weighted market portfolio is the most efficient portfolio in the universe. So how do you calculate value-weighted weights? In other words, I ask you how much in percent you will invest into each of the stocks. So if it's a value-weighted portfolio, well, it will be proportional to the size of company compared to all other companies taken together. So for IBM, it would be the value of IBM divided by sum of the values of all other companies. So in other words, into IBM stock, you would invest 16.67%. In Microsoft stock, you would invest 38.89%. In Google stock, you would invest 44.44%. So these are your weights. Then I would ask you, okay, calculate the expected return of this value-weighted portfolio. So how do you calculate the return of any portfolio of 3 stocks? Well, it will be just the weighted average. So what are the weights here? The weights you have calculated in the previous step. Weights will be 16% goes into IBM, 38.89 into Microsoft, and 44.44 goes into Google. So in other words, 16.67% times the expected return of IBM plus 38.89 that goes into Microsoft times the 20% which is expected return of Microsoft plus 44.44%, which is the percentage that you invest into Google, times the 22%, which is the expected return of Google. So this would be the expected return of your portfolio. Now the question is, what is the riskiness of this portfolio? This is the tricky part. The tricky part is, how do you calculate the risk of such a portfolio? So how do you calculate the risk of portfolio of 3 stocks? Well, you need to calculate what is called the variance-covariance matrix of this portfolio first. How do you calculate? Well, this matrix will be of size 3 by 3. Then you need to fill in the numbers into this matrix. We know how the diagonal elements will look like. The diagonal elements are there to capture the movement of stock of each of the stocks. So the first element will be proportion that you invest into stock 1, which is IBM, to the square times the standard deviation of stock 1 to the square. So we know that the proportion that we invest into IBM is 16.67%. So this will be W1. You have to put this number to the square. Times standard deviation of IBM is 20%, so 0.2 to the square. Now you would do the same thing for the rest of the diagonal element. This diagonal element would be there to capture the movement of Microsoft stock, and this one would be there to capture the movement of Google stock. Okay, these are the diagonal elements. Now let's go to the off-diagonal element. This off-diagonal element would be there to capture the co-movement between IBM and Microsoft. So this would be W1 would be proportion that you invest into IBM, W times proportion that you invest into Microsoft, times the correlation coefficient between IBM and Microsoft. And you can see in this table that the correlation coefficient between the returns of IBM and returns of Microsoft is 0.5. So this is rho. This is the Greek letter rho. This is not P. This is the correlation coefficient. And this correlation coefficient is equal to 0.5. You can see it in this table. Times the standard deviation of IBM times the standard deviation of Microsoft. Now the element in row 1, column 2 would be exactly the same. In a similar way, you would fill in the remaining elements of this matrix. You will calculate their numerical values, and you can see that they are symmetric in a sense. Element in column number 1, row number 2 is the same as element in row number 1, column number 2, etc. So all the diagonal elements are symmetric. You would add these numbers together. That would be the variance of your portfolio. The square root of this number would be the standard deviation of this portfolio. So this would be kind of a risk of your portfolio. Now you have calculated the risk and the return of a value-weighted portfolio, and you have also calculated the weight yourself. This exercise also carries quite a lot of points. Now, which portfolio had the highest average risk premium during, let's say, 20th century? This is clear. Common stocks. Common stocks were the riskiest. They had the highest risk premium during this period. What is the beta of the US government bonds? It's 0. I feel like a quiz host. In the presence of a risk-free asset, the investor job is to invest in the market portfolio, find an interior portfolio using quadratic programming, borrow or lend at the risk-free rate, read and understand Markowitz's portfolio theory. Well, think about it. In a perfect world, we said, where we have this lending and borrowing at the risk-free rate, the optimal combination of investment goes by either borrowing and lending at the risk-free rate, and at the same time you invest into the value-weighted market portfolio. So the answer is B. Why? Because 1 says invest into market portfolio, and 3 says borrow or lend at the risk-free rate. So the optimal thing to do, how do you reach these optimal risk-return combinations on the security market line, is by mixing the market portfolio and portfolio of bonds, which give you a risk-free rate, or you can also borrow at a risk-free rate and invest more than you have into the value-weighted market portfolio. If the beta of Amazon is 2.2, risk-free rate is 5.5%, and the market risk premium is 8%. Calculate the expected rate of return on Amazon stock. So we use the capital asset pricing model to solve this problem. And the capital asset pricing model tells us that the return on Amazon stock should be the risk-free rate plus beta of Amazon times the market risk premium. In other words, this will be risk-free is 5.5% plus beta, which is 2.2 times. Now, pay attention what is written in this text. It says that the market risk premium is 8%. If the market risk premium is 8%, you just plug in 8% here, okay? Where students sometimes make a mistake, they would say 8 minus 5.5. Pay attention what is written. I have no intention to mislead you with these kind of questions. I simply cannot anticipate what you will think what you read, in a sense. I have written here market risk premium in order to make your job easier, in a sense. So you don't have to subtract things. But sometimes, as you will see in the second exam, I did it a little bit in a bit different way. So when I did it like this, some people got confused, and instead of using 8% as a market risk premium, because RM minus RF is what we call market risk premium, how much stocks give you more than bonds. And the correct answer is 23.1. Now you have a very similar question, which is just instead of using capital asset pricing model, you are asked to calculate this thing using the three-factor Fama and French model. Now, what do we see from here? Well, you just need to plug in the numbers into a three-factor Fama-French model. All the numbers are given. You just plug them in and you get the solution. And the correct answer is C. And that's it. That is the exam number 1. Now we go to the exam number 2, which is pretty similar. Now, your exam will not be so similar to these exams as these two are. I have to make some differences, but the level of difficulty will be exactly the same. This will be the level of difficulty that you can expect. I will, of course, have to modify problems so that it's not that you learn by heart these solutions and you solve them. And actually, as much as I want, you can have the solutions to these problems on your cheat sheet that you want to bring with you. I don't care. On your cheat sheets, you can bring whatever you want. I don't care what is written on a cheat sheet. Whatever you want. There are no rules there. Exam number 2. Does this problem look familiar? Is this problem familiar? It's exactly the same as the problem number 1 in exam number 1, just with different numbers. And the solution procedure is the same. You first write down the equation for the, so this is what you need to find. You need to find the future value. Now, in order, what is else given? It is given that the present value of $1 is 0.2. Well, from there you can find what is 1 plus r to the power of n. You can plug it into your future value equation and you get to the answer, which is $5 in this case. Is this problem familiar? It is almost the same. I just give two redundant informations, PE and EPS, but they are irrelevant. But the problem is exactly the same as problem number 2 in exam number 1. This is how similar these exams were, and there were still some people that managed to fail this exam, which I find devastating for me. And I have provided the solutions and the exam of the first exam on my website. So solve this, understand these problems that we are solving. Of course, I will not give you the same problem now, but understand them. Understanding of these problems will be crucial for a good score. But understanding, not learning by heart. If you understand these problems, you will be able to score a perfect score on your exam. I promise you that. Okay, a little bit different problem than there. So a problem like this was not on the first exam. And it's related to the calculation of the forward rates. I give you current spot rates. These are basically the rates that describe term structure of interest rates. What are the interest rates for different terms, for different maturities? And given these interest rates, given these spot rates, you are asked to solve a problem that people in the industry solve on a daily basis. You are asked to calculate first the forward rate that starts in 3 years from now for 1 year. In other words, you want to borrow money today, you want to sign a contract today that you will borrow money in 3 years from now for 1 year. How do you solve this problem? Well, do the thought experiment. The thought experiment is you walk into a bank today, you want to invest for 4 years. Bank will give you a 4-year spot rate. Alternatively, you can do exactly the same thing by walking in today and borrowing money for 4 years. However, you do it with 2 contracts. First contract is for 3 years, and then you oblige yourself that after 1 year, you will have 1 more year contract. So 1 plus r to the power of 1 plus r4 to the power of 4 is equal to 1 plus r3 to the power of 3 times 1 plus forward rate from year 3 to year 4. If you plug in the numbers, and solve this equation, you will obtain your forward rate. But pay attention, in order to plug in the numbers here, you need a 4-year rate, and 4-year spot rate is not given. You need to calculate it. It will be the average between these two. Yes?
But we will use the same formula if so if it was said that we have 1 contract for 3 years and 1 contract for 1 year after the 3 years. So how does this formula show that we actually don't have the contract for the first 3 years and only 1 contract for this year from year 3 to year 4?
So this is what we are searching for. This is exactly what, so we are searching the rate that you will be charged from year 3 to year 1 contract. But when you do this thought experiment, you will be able actually to find what is this rate. This will be your forward rate from year 3 till year 4. Okay? This is what you are searching for. And you just solve this equation. Your forward rate will be 1 plus r4 to the power of 4 divided by 1 plus r3 to the power of 3 and then minus 1. Okay?
So is this rate always the same if we have another contract before or if we don't have the...
It doesn't matter. We just use this thought experiment to calculate what is the forward rate. You don't have any of these contracts. You just want to have 1 contract from year 3 till year 4. This thought experiment is here to help you think about this problem. To say, okay, it must be the same if you go into contract for 4 years or to take 2 contracts that will effectively give you a contract for 4 years. This is just a thought experiment, nothing more than that. You don't have any of these contracts. The only one that you would like to have is the contract from year 3 till year 4. Then we modify this question a little bit, and I ask you, which rate would you pay under same conditions except that you borrow money for 2 years? If you borrow money for 2 years, you do a different kind of a thought experiment. And this thought experiment would be, you invest for 3 years, and then you invest for 2 more years. This must be the same as if you invest for 5 years. And then you solve for your forward rate from year 3 till year 5, and you get the solution. That's it. Why am I insisting so much on this? Because companies use this all the time. Companies constantly sign contracts today to borrow money in the future. Think about Lufthansa's business. They don't want to gamble on what are going to be their future interest rates on the loans. And they know that in 6 months from now they will need a plane. And they actually already today are charging you for a flight that will take place in 6 months from now that will be realized using the plane which was bought using money that they have borrowed. So in order to be able to tell you what is the price of this ticket, they need to know what is the price of doing their business. And interest rate that they will be charged is going to be the price of their business, in a sense, part of the price of their business. Okay, we have 2 bonds, bond AAA and bond BBB. Bond AAA is a 0 coupon bond and it matures in 2 years. Bond BBB is a coupon paying bond which has a coupon rate of N%. It matures in 4 years and has a duration of 1.5 years. Price of which of these 2 bonds is more sensitive in changes in interest rates? Now, the way how you should think about this problem is the following. What is the measure of the sensitivity of a bond price to changes in interest rates? It's the duration. And we know that the duration of the second bond is 1.5 years. And what is the duration of the first bond? It's 2 years because it's a zero coupon bond. Therefore, bond AAA is more sensitive to changes in interest rates. Okay? Okay, again, you have a problem where you need to calculate the price of a US government bond. You are presented with a table which contains term structure of interest rates, and you are given a description of a bond. And I ask you, first, draw the diagram representation of the cash flow stream offered by this bond. This is a $1,000 bond. Coupon is 10%. They are paid semi-annually, which means that 10% of 1,000 is 100. So half of this amount you receive every 6 months. So your coupons will be $50, and the final payment will be the face value plus the last coupon. Okay, this is the first part of the problem. The second part of the problem, what is the present value of the first 5 coupons? Again, you have to discount them using the corresponding rate. A 6-month coupon would be discounted using 6-month rate, but this 6-month rate is nominal annual with semi-annual compounding, and it's in percent. So 0.15% is 0.0015 if you write it as a decimal. Now, you get half of it every 6 months, so this will be the present value of the first coupon. The second coupon that matures in 1 year, you take a 1-year rate, you divide it by 2, that will be how much you will get after every 6 months. And there are 2 6-month periods. This is why we have to the power of 2. Then for the third coupon, which matures in 1.5 years, well, you don't have this rate. So you have to calculate the average between the year 1 rate and year 2 rate. And this will be 0.0024. Now, half of this rate you get every 6 months. And there are 3 6-month periods in a year and a half. This is why we put it to the 3, etc., etc. And you would calculate the present value. Next, what is the present value of the payment that this bond gives at the date of its maturity? At the date of its maturity, this bond pays the face value plus the last coupon. You have to discount it with the appropriate rate. What is the rate? Well, 3-year rate is 0.37. But this rate is nominal annual with semi-annual compounding, which means that you get half of it every 6 months, and therefore we have to divide it by 2 and put to the power of 6, because there are 6 6-month periods within 3 years. And then finally, estimate the market price of the bond. Well, that will be the sum of the present value of coupons plus the present value of the last payment that comes at the date of maturity, which consists of the face value and the last coupon, and you would get the market price of this bond. Okay? Then, again, we have a problem in which you have to calculate the present value of a very complex cash flow stream, and this carries almost 20% of the points on the exam. So learn how to do it. It's a straightforward thing if you think about it. We have learned all the tools necessary to solve these kind of problems. So let's see. Draw the diagram representation of the whole cash flow stream, including the investment. So this is our timeline. Investment is 5,000. Then in year 1, 2, and 3, we have some amounts of money, which are different. Year 2 is 0, year 1 is 300, year 3 is 600, year 4 is 400, and then from year 5 on, we have 800 each year until year 28. And then in year 29, we have 1,000, and then it grows at a rate of 10% forever until eternity, and the discount rate in this problem is 15%. And then I ask you, what is the present value of cash flow streams received in year 1, year 2, year 3, and year 4? So, what is the present value of this cash flow stream? Well, it will be year 1 discounted, year 2 basically does not exist, it's 0, plus year 3 discounted, plus year 4 discounted, and we end up with some present value. Okay? Then, what is the present value of 24 cash flow streams received in years from year 5 till year 28, both year 5 and year 28 included? Now, how do we call this cash flow stream? This is an annuity. It pays constant amount of money each period of time for some period of time. It doesn't go until eternity. And we said that the present value of the annuity is given by this formula. But the problem again with this formula is that it assumes that the first payment starts in year 1. Now, how do we adjust this formula? Well, let's look at this cash flow stream, our cash flow stream, which starts in year 5. Let's look at it from the perspective of year 4. From the perspective of year 4, it looks just like a normal annuity. So we use this formula to calculate the present value in year 4. So in year 4, this is how much it will be worth. Now pay attention, this t to the power of t is actually 24, because year 28 from the perspective of year 4 looks like year 24. So this will be the present value of this cash flow stream from the perspective of year 4. Now, how much is it worth today? We need to additionally discount it for 4 more years. Okay. And the final part of this problem is we need to calculate the present value of the last part of the cash flow stream, which starts in year 29 and it goes until eternity. It starts with $1,000 and it gets 10% larger with each payment. Okay, so we start in year 29. We start in year 29, and then year 30 we have 10% more, and each period 10% more. So how is this cash flow stream called? This is what is called the constant growth perpetuity. It gets larger and larger and goes forever and ever. But you see, constant growth perpetuity formula assumes that the first payment is in period 1, and here the first payment is in period 29. Since the first payment is in period 29, we can look at this problem from the perspective of year 28. If you put yourself in the shoes of the year 28, it will look like that the first payment, which is in year 29, actually takes place in 1 year from now. So if you apply this formula, and you can apply it because the growth rate is 10% and discount rate is 15%, from the perspective of year 28, this is how much this will be worth. So we need to additionally discount it for 28 more years, and you would get some number. And finally, I ask you, what is the total present value? Well, you add investment plus all these A, B, and C cash flow streams that you have calculated, and you get the net present value of this cash flow stream. And that's it. This is 20% of the exam. And with probability 100%, you will get a similar problem to these problems. So it's for sure that you will need to calculate the present value of a complex cash flow stream. So please try to understand these things. Please try to understand how to use annuity, constant growth perpetuity, and constant growth annuity formulas when their payments start in different periods than year 1. Because reality is like that. Usually the first payment is not in 1 period from now. And as I said, this is the literacy of business school. If you don't know how to do that, it's like you would not know how to write after your elementary school. This is simply something that, everybody, no matter what you intend to do in your future career, whether it's marketing or whatever, this is like saying, but I'm not interested in this, I want to do marketing. This is like saying, well, I'm not interested in this because, I will study math, so I don't need to know how to write. It doesn't work like that. Okay, then again we talk about a little bit about conversion of units, understanding the units of interest rates. So an interest rate is 7% per year when expressed with continuous compounding. What is the equivalent rate when expressed as nominal annual with daily compounding? So the rate with continuous compounding gives you the same amount as the rate expressed with daily compounding. If you solve this equation, this will be the answer to your problem. And you see, They are very, very similar. An interest rate is 8% per year when expressed with continuous compounding. What is the equivalent nominal annual rate with semi-annual compounding? Well, then you would solve this problem. In other words, if you compound continuously with this rate, the question is what kind of rate do you have to use to compound if you compound nominal annual with semi-annual compounding, and that after 1 year you get the same amount of money. And if you solve this equation, you end up with 8.16%. Then we go again to stocks and portfolios. You are given a table which contains the value of companies, their expected returns, their expected standard deviations, and their correlation coefficients, which describe how returns of these companies move together. You would have to calculate, again, I ask you, calculate how much in percents you invest into each company if your portfolio is valuated. In other words, you invest proportionally to the size of this company compared to all companies taken together, and these are your weights. So it means that 32.3% you invest into IBM, 34.3% you invest into Microsoft, and 33.4% you invest into Google. Then I would ask you what is the expected return of this portfolio, like in the previous exam, and this is just the weighted average. You have weights, you have expected returns, you solve this equation, and you end up with the solution of 11.024%. And again, I would ask you what is the risk of this portfolio? Well, how do you calculate the risk of this portfolio? You construct a matrix of 3 by 3, because there are 3 stocks in this portfolio. So this will be your variance-covariance matrix. This variance-covariance matrix will have diagonal elements which will be there to capture the movement of the stocks, and of the diagonal elements which will be there to capture the co-movement between the stocks. And basically, once you have calculated the weights, you have all the ingredients to calculate the values of each and every element in this matrix. Then these would be numerical values of these elements. Sum of these elements would be your variance, and the square root of it would be the standard deviation of this portfolio. Therefore, if you know how to do this, you basically know how to calculate risk and return of any portfolio, which is which is one of the main goals of this class. As the number of stocks in portfolio is increased, what is correct? Unique risk decreases and approaches to zero. Market risk decreases. Unique risk decreases and becomes equal to market risk. Total risk approaches to zero. The correct answer is A. If you remember the chart from my class where you have plotted the portfolio risk with respect to number of securities in portfolio, what you can see in that chart is that the portfolio risk is decreasing and is approaching market risk, while this unique risk completely disappears as the number of portfolios. In a sense, you get rid of all idiosyncratic risk. All company-specific risk disappears and approaches zero. Market risk does not decrease. Market risk is market risk. Unique risk decreases, this is true, and becomes equal to market risk. This is not really true. It does not, unique risk goes away completely. Your total portfolio risk does approach to market risk, but unique, idiosyncratic, firm-specific risk goes to zero. And total risk approaches to zero is obviously not correct. Portfolio of any risk at best will be equal to the market risk. Underpriced stocks are those that are cheap, or in other words, stocks that have current price lower than the stocks of equal risk. If a stock is underpriced, it would plot above the security market line, below security market line, on the security market line, on the y-axis. What we know for sure is that it won't be plotted on the y-axis. This is where riskless things are plotted. We know that it won't be on the security market line, because on the security market line are only those that have correct price. So what are the underpriced stocks? Underpriced stocks are those that are cheap. Cheap stocks have high expected returns. High expected returns means above the security market line. Therefore, the correct answer is A. And again, application of the capital asset pricing model. If the beta of Microsoft is 0.98, the risk-free rate is 0.5%, and the return on market is 4%, calculate expected rate of return on Microsoft stock. Expected rate of return on Microsoft stock, according to the capital asset pricing model, will be equal to the risk-free minus beta times market risk premium. Or in other words, it will be 0.5%, which is the risk-free rate, plus 0.98, which is beta, times, now market risk premium is return on the market, 4%, minus the risk-free rate, 0.5%, and you obtain the number of 3.93%, which is answer D. Now, pay attention. In this example, I have given return on the market and the risk-free rate. In the previous exam, I have given the market risk premium. In both cases, there were groups of people that did it wrong. In a sense, in the previous case, when I gave market risk premium, they would take market risk premium and subtract risk-free rate. In this case, they would take that the return on the market is the same thing as market risk premium, which is not.
Why is there a plus in the second
Okay. Again, the application of the Fama-French three-factor model, you are asked to calculate the expected return of two companies using the Fama-French model, and the Fama-French model is given by this equation, and you have to just plug in numbers for Microsoft and for Apple, and you would get some answer. Now, try to think what it means. I mean, the goal of this is, not just that you learn how to copy numbers into these formulas. Try to think about it. Capital asset pricing model is what most people understand. Fama-French three-factor model is basically the same thing, just there is not one source of risk, which is beta, which how this company moves together with the market, but there are some other betas. There is beta related to size and beta related to the book market value of that company, which are kind of different sources of risk. So higher any of these betas is basically increasing your risk. The higher the betas, the higher the risk is. So this would be the end of this talk, and yeah. Any questions, comments, short speeches? We're done.